Why are bond prices and their implied interest rate inversely related? Let's take a look. So in the macroeconomics class, you might sometimes see money supply, money demand curves. And the question may be, well, if we're not in the intersection of both and we have an interest rate that is either below or above, how will we come back to this equilibrium point? And that is based on the buying and selling of bonds. You would sell off bonds if you have a greater money demand than money supply at the going rate, because you want more money as cash than you currently have. And that's going to trickle the process. And the opposite would be true if the interest rates are really high. You're going to buy more bonds because you don't want to keep as much money as cash in that situation. So why is bonds price and implied interest rate inversely related? So as one's going up, the other one's going down. So let's understand this. A bond, regardless of the type of bond it is, let's just keep it simple. A zero coupon bond has a maturity date in the future, and at that maturity, unless this company or this government goes bankrupt, you will receive this amount of money, face value. Let's say it's $1,000. So, and let's say the maturity is in 1 year's time. So you buy this piece of paper, essentially this bond, this financial instrument that matures in a year and will give you back $1,000. You're not going to pay $1,000 for that now, because otherwise, if you do so, you're just lending them money and getting no return. So the way it works is that you will buy a bond at a price that is smaller than 1,000, and over the course of the time that you hold it, potentially gains value. We'll see some of the different things that could happen there, but one thing's for sure is if this company does not go bankrupt, you will get 1,000 in a year's time. Let's say you buy it at $950, gives you about 5% interest over this period of time, because you go from $950 to 1,000, so you gain $50 in interest over this period of time. So you're getting roughly 5%. Okay, that's the situation that you start with. But let's say for some reason, a lot of people want to sell off their bonds. We'll get to those reasons later. But let's say some people want to get rid of those bonds because they want to have access to cash. Well, if you own this piece of bond, let's say you bought it yesterday for $950, matures in a year, you bought it yesterday, and your car breaks down and you're like, I really need money the day after. Well, let's say everyone in the economy, their car breaks down. So a lot of people want to get rid of this bond. Well, as a lot of people want to get rid of it, it's going to lead to a situation where if I want to sell mine and no one wants to buy at $950, and there's a bunch of us that want to sell at $950, and well, I'm going to start lowering my price, just like any other thing that you want to sell. If you want to sell a used computer, whatever, you're going to have to lower the price if no one's buying it. So as these people lower the price to reach a buyer, you might have bought it for $950, and let's say that a few days later you sell it for $900. Well, this person bought it at a lower price. So price has gone down, and I said interest rates are inversely related. Why is interest rates inversely related? Well, if you think, let's say the day after this person bought it for $900, so there's still like a year's time, and this person, if he keeps it for that whole year, he's going to go from $900 to $1,000. So now his interest rate's a little bit more than 10%, because you're not going from 900 to 990, you're going from 900 to 1,000. So you have this situation where the rate of return on this bond goes up. Assuming that on a given day, you go from this price to a lower price, that means that the path to get to that $1,000 in a set time period is now greater, which means that because you've dropped, that path is greater, you have a greater rate of return. On the opposite, if a lot of people wanted to buy this bond at $950 and it brings up the price, well, then the path to 1,000 at maturity is smaller, therefore the rate of return is smaller. So what could be some of the causes why price of bonds go down in price, or people want to get rid of them, or they're less appealing? There's multiple reasons that it could be, but let's just keep it simple to one. assuming that interest rates change in the economy. So this company releases bonds one day and it sells at a 5% discount because that's more or less the going rate for a company of this default risk. So depending on the bond rating, AAA or junk bond or whatever, that's how much rate of return should be. But then if for some reason interest rates change, the central bank changes policy and other things happen in the economy, and now all of a sudden the rate that they're going to have to give to collect more money, because it's a debt instrument to get more money from the public as they issue new bonds, is now 10% the day after. Well, that means that the bonds that they sold the day before will go down in value as well. Because why would you buy someone's bond that he'll sell it for $950 when you could buy a new one for $900? There's no reason. So that's the kind of situation that happens. They're going to have to lower their price to issue more bonds, and the price of the ones that have the same maturity and the same default risk and everything have no reason to keep selling for more. It's not like they'll be priority if this company goes bankrupt. They're the exact same financial instrument. So as rates change in the economy, it's going to have an influence on bond prices. So that's why we say as interest rates go up in the economy, it's not necessarily a good time to buy bonds, because you might buy a bond that pays 5% interest and interest rates are going up. And now the same kind of bond should be paying 7 or 8% interest. So it means that as that implied interest rate goes up, it means that the price that your bond is worth is actually going down. Bonds are seen as a very stable, very good financial instrument. The way that some people sell it, some financial investors will say bonds are nice and safe because you know how much you're going to get. Unless this company or this government goes bankrupt, you know exactly how much you're going to get. And I agree with that. However, there is a big however. That is only true if you keep this bond to maturity. So if you bought it at $950 and you know that if you keep it for a whole year, you'll get $1,000. But if there's something that happens that means that you have to sell it a few months from now, well, it would suck if you would sell this bond that you bought for $950 for actually less than $950 because interest rates have gone up. So in times where interest rates are going up, bonds are not necessarily your best financial instrument because the value of those bonds can fall over time unless you keep them to maturity. So if you keep it, you know how much you're going to get, but you can also delay and put your money elsewhere and then buy it at a cheaper price and then get a bigger rate of return. But in this class, you have to understand that there is this negative relationship between prices of bonds and their implied interest rate. Thank you for listening. Catch you on the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.